And we are live. For this session, we are going to visit Confluence and Confluence factors, Confluence weight distribution, at least from my perspective. Again, this is something that I think you're all going to discover on your own through your own journey, what Confluence factors mean more to you. And the reason why I say this is because even despite, I could drill the way that I look at Confluence for hours and hours and hours on end, but I still have a different pattern recognition system in my brain than you. So where Confluence comes into play the most is over time, believe it or not. It's not in your technical analysis day to day. It's really over time, over your brain repeating, seeing those repeated patterns over and over and over again, and then through chart time, logging whether those patterns are successful or not, right? And then being able to eventually recognize higher probability patterns by pulling back into those memory banks and looking at what statistically has worked more. The brain is a wonderful machine with a vast array of functions that we don't consciously access, and pattern recognition is one of those functions that kind of is a process that runs there in the background, not taking up too much active CPU, right, or too much active memory. And that is why you will probably develop your own pattern recognition over time and your own weighting system as to what works better, what doesn't work better, in terms of the Confluence factors. Okay, but I just wanted to lead with that as a way to tell you that don't worry if what you look at and the way you look at it is different to mine, because it could be equally valid. Yeah, absolutely equally valid. Think about it this way: there are people who use 50 indicators. I don't know if you've seen those charts from some reputable analysts. Like I follow some key figures that are analysts in, on Twitter, and sometimes they pull these charts out that I'm like, I just can't see through. I cannot see the patterns or the candles or anything through them. Have you ever seen the ZUP indicator, the ZUP? I think it's in version 200 now or something like that. I started using it when it was like in 60 something. And it's a harmonic indicator that also has pitchforks and I don't know what other crazy ass stuff. And you put that without any modification of the settings on your screen, and you cannot see price action. Yeah. So again, there's nothing better than anything else as long as it works for that person, right? You can't be overly boastful of your Confluence system, because it might work better or worse than somebody else's, which is either more convoluted in your eyes or super simple in theirs, right? So again, going back to what I'm trying to say here is that you could have a whole different set of indicators that work for you, and as long as they work for you, they are perfectly valid and as valid as the ones that we use here. That's the first thing that I teach when it comes to indicators. And indicators are just that. They are indicators. They are mostly lagging when you look at technical analysis, right? They are mostly lagging indicators. They're indicators that react to where price is at the moment. The only ones that could be considered slightly leading are the fibs, right? The ones based on fibs or based on fractal projections and things like that, like the SHI, Fibonacci extensions and retracements, things like that. But MAs, man, those depend on price. The stochastics depends on price. Structure depends on price, on all historic lagging type indicator. And as such, I never recommend looking at any indicator in isolation, right? If anybody is trading based on only one indicator, they need to have a reason for that, right? If it's a naked chart and there's only one indicator, for example, it probably works for that person and that's all they're basing it on, as long as it works, right? These strategies that are based just on MACD, crossovers on stocks or just based on, MA crossovers or trend lines alone or things like that, those things are usually don't work because they are strategies based on lagging indicators for the most part, and you don't know if price is going to react to them or not, right? What we do know, is that statistically, the more of those that coincide, right, the more self-fulfilling prophecies that you can find at a specific price level or zone, the higher the probability of you getting the reaction that you're looking for, which is why we use indicators, because, in this case, it just helps us visualize certain things. Now, I can tell you that after enough time looking at screens, right, you probably don't need a single indicator on them, right? You can, yeah, oh my God, yeah, Frank, exactly. It's something like that. That is insane. Like, who can trade like that? And there are people who trade like that. I doubt their success level, but it is possible. Short, yeah, no? So what I'm saying is that eventually, like, if you take all the indicators out of the screen, I can probably tell you where stochastics is. I can probably tell you where the MAs are. I can probably tell you where structure is. Well, that's easy, right? I can tell you where the SHI channel is. I can tell you what the fib levels are. I don't even have to draw them anymore because I can visualize them, right? And that just comes from practice and practice and practice of looking for the same things over and over and over on every chart that you look at. And it's just a matter of practice. And that's another thing that is similar to what we were talking about yesterday with the levels. As we spotted the levels, that at the beginning of anybody's journey, the indicators are going to give you counterintuitive information. They're going to be conflicting in many cases. They are going to be confusing. They're going to be baffling, right? And you're not going to know how to read them up or down, right? At the beginning, right? That's how everybody starts. And I think through everybody's journey, except this dude, whoever Frank got that chart from, at the throughout the journey of learning how to really spot levels and trades and Confluence, eventually you kind of peel off almost everything, right? And you just keep the things that your brain knows and that your statistical tracking data has shown in the past that kind of works for you. Again, statistical tracking and data performance analysis and all of that is something that is very geeky, I guess, and niche, but I will do a session on that because, I went through it. And why not share my experience, right? Somebody might find it useful. But in this case, let's assume, right, before we look at any of these confluence factors, that the ones that I'm using are the ones that through my experience, right, and it could be different for everybody, through my experience have proven to be the most reliable when they are happening together, okay? The other thing that I wanted to point out before we actually get into examples here is that when I started developing the system that I currently use, and that was, widely dependent on a lot of the teachings that I received from Mike many, many years ago. One of the things that I added and that is in conjunction with data performance tracking and analysis, right? Because I tracked everything. I journaled all my trades. I had statistical stuff pulled out of them, and I knew if a cable trade short on a Wednesday after PMIs was more successful or not than, another type of trade, and all that cool stuff that took way too much effort, right? But that had some, there was a moral to that story, and I'll share it one day. But the one of the things that I did in conjunction with that is when I was learning to decide what was more important, price hitting an MA or stochastics, or what was more important, an SHI being hit or structure, right? When I was trying to determine which one of those I wanted to give more weight to at the beginning, I created a very simple, and I'm definitely not the pioneer in that I got that idea from somebody for sure, was a trade idea score, right? So I would score my my trade ideas. Now, this is something that Mike used to teach, and I guess it fell for the wayside or something. I just can't remember him talking about it recently, but he would have different trade sizes for different confidence levels, right? He would say, okay, this is a low confidence, at least that's how he taught me, right? This is a low confidence trade. This is what you look at. This is a medium confidence trade because of this, and this. And this is a high confidence trade because of X, Y, Z, adjust the size for all of them, boom, go from there, right? So from that concept, I developed my own, again, personalized and based on my experience, trade idea scoring system, where I assigned, super simple, I assigned a number of points to each confluence factor that I spotted in that trade idea that I wanted to develop. Yeah. So as an example, before we go into details, right? For example, the maybe structure was 1 point, but structure that coincided with a higher time frame was 2 points. The MA's crossover maybe was another 1 point. The stochastics was another 1 point, right? I'm just talking here as examples, but basically every confluence factor had a weight that I assigned through points. And as I progressed through that phase of my learning process, I shifted those weights a bit depending on what the data told me over time. Maybe when I initially developed the trade idea score system, maybe I had assigned 1 point to the MA, and then maybe by the end, 6 months later, the MAs were worth 2 points, right? Again, that was very personal, dependent on what you had observed and what you had seen. And then that trade idea score will have a score, let's say, as an example, from 1 to 10 points, right? With the higher confidence trades being those that had 10 points worth of confluence accumulated, and the lower confidence trades being the ones that had only 1 point of confluence factors accumulated. And that would help me gauge, A, whether I wanted to take the trade in the first place, right? And B, how much I wanted to put size-wise on that trade, always within my thresholds. And C would also help me determine things like damage control triggers and targets and things like that, because depending on the confidence level, I expected an X move or a Y move, right? Depending on all those factors. And the trade idea score developed into a disciplinary system for me that forced me to really analyze my setups, because now we're talking setups. We're not talking trade planning. We're just talking setups. What determines a good trade idea that you want to execute as soon as possible, right? Regardless of entries. We're talking setups, not entries. Entries, again, we can talk for ages on entries, but setups depend on the confluence factors that you spot, and then that determines whether you have a trade idea or not. And this trade idea score allowed me to have, to see what happened with trades that scored 8 versus what happened to trades that scored 2, right? And sure enough, over time, the higher scoring trades usually, for the most part, performed better than the lower score trades. There were anomalies on both sides. Why? Well, because this is the law of probabilities in action. This is all about statistics. It's all about probabilities and odds. And over time, you're going to have outliers in your sample size, right? And those you have to ignore, and you have to keep going with your system so that the law of probabilities plays out and your edge plays out. We've talked about contaminating your edge by reacting to outliers, right? And points that are not within the appropriate averages, things that are exceptions maybe, right? So sure, there were some 2-score trades that I took as tests that ended up with fantastic gains. And there were, perfect 10-score trades that, hit the damage control trigger, right? You never know. Again, it's all about odds and probability. But it didn't help me create that discipline in, analyzing the setups in a consistent manner, because I realized that the more consistent that I could be with all my systems, the easier it was to project into the future, whatever was going to happen, and the easier it was to analyze. It was much easier for me to spot weaknesses in my game if everything that I did was consistent, because I could really quickly drill into what the problem was, versus inconsistent practices, which would make, I guess, make it a wild guess as to what the heck went wrong if every trade is taken under different circumstances and different considerations.